Give me one moment.
All right. Good evening. Welcome back to our workshop session for our meeting this evening. And we have two items on the workshop session. We are that this portion of the meeting is starting at 6:01 p.m. with council members Allen, Karn, and Gay present. Item number one on the agenda is the presentation of the comprehensive annual financial report for fiscal year ending June 30th, 2021 by external auditors Malden and Jenkins. And so I will turn this over to Ms. Flord Bradley, and I believe that she'll be introducing some other people.
Good afternoon, Mayor and Council. I have to make one correction. It's no longer referred to as the comprehensive annual financial report, but the annual comprehensive financial report. That should have been corrected by me. I would like to introduce to many of you who already know our auditor, Doug Moses from Malden and Jenkins. He will be presenting the results of the fiscal year 2021 ACFR. The floor is yours, Doug.
Thank you. Good evening to everyone. Thanks for having me here to present virtually. Hopefully everyone can see my PowerPoint presentation, and hopefully you all have had a chance to look at the ACFR as well as the single audit report, management letter, as well as the auditor's discussion and analysis. As far as tonight's presentation, I'm going to touch on the highlights on this PowerPoint presentation. And if you have any questions, you can stop and ask, or we can address any questions or comments you may have at the end of the presentation. All right, so we'll go ahead and get started here. Just kind of update about our governmental practice and the firm. We now have 12 offices. The latest addition were 3 offices in North Alabama. So we have offices in Athens, Florence, and Huntsville, Alabama. So that makes 12 in 5 states. We serve over 565 governments, and of those, we have probably 140 plus that received the GFOA certificate of excellence in financial reporting, and that includes the city of College Park, as you all have been receiving that award for many years now. As far as the engagement team, I was the partner responsible for the city's overall auditing with 23 years of experience. This year I had a different partner to do the quality assurance review, Meredith Lipson. She has over 30 years of experience, and it was her first time doing this review for the City of College Park's engagement. Down below is just some other industries and services that we provide, including our governmental advisory practice that's led by David Roberts. As far as the financial statements are the responsibility of the mayor and council and management. Our responsibility as your external and independent auditor is to give an opinion on the financial statements. We've issued an unmodified opinion, which is a clean opinion, which is what you will hope to get from the external and independent audit. Our opinion did include the Business and Industrial Development Authority, BIDA, which is considered a blended component unit that's reflected in your financial statements as a proprietary fund. Our opinion did not include or cover the Atlanta Airport District Destination Marketing Organization, DMO, which is reflected in your financial statements as a discretely presented component unit. We relied on other auditors' report. Again, we did not, our opinion did not cover that particular information for the DMO. This year, you all were required to have a single audit in accordance with the uniform guidance. You received and expended at least $750,000 of federal awards. You had total federal expenditures of about $1.4 million as of June 30, 2021. And the program that was considered to be a major federal award program was COVID-19 program, which you all received and expended about $706,000. And so we've issued a clean opinion or an unmodified opinion on that program. Within the single audit report, there's a yellow book report in accordance with the government auditing standards. Again, clean report, we did have a finding, although it says compliance finding here, that's actually a management recommendation, and we'll talk about that one a little later, along with the one finding on the financial statements side, but we'll cover that a little later in the presentation. As far as significant accounting policies, the one main thing here is where you all did have to implement GASB 84 relating to fiduciary activities. Your municipal court fund is no longer an agency fund that's reflected in your financial statements. It was deemed not to be a material custodial fund. So therefore, that activity is actually reflected within your general fund for financial statement purposes. And so that's the only significant new policy that was implemented that affects your accounting. As far as our relationship with management, we received full cooperation from city's management staff and others. There were no disagreements with management on accounting issues or financial reporting matters. We did post audit adjustments. Only one was deemed to be material that resulted in a finding. And we'll talk about that a little later. But again, there was no past audit adjustments, meaning that anything that came to our attention, we went ahead and proposed those adjustments, and those adjustments are reflected in your financial statements. As far as our independence, we are independent with regard to the city and its financial reporting process in accordance with AICPA professional standards. There are no fees paid to Mullen & Jenkins for any type of management advisory services that will have impacted our independence as your external and independent auditor. All right, the next few slides kind of go over some financial trends. I always like to show like a 10-year comparison. And this first slide is just looking at your operating and interest revenues over the last 10 years for your electric fund and then your other proprietary funds as a whole. Your electric fund revenues actually went from 29.6 million in 2020 to 36 million in 2021. And the main reason for that increase is related to your power cost adjustments and demand charges, which resulted in that increase. Your other proprietary funds revenues went down from 27.7 million to 22.3 million. And that's due to the continued pandemic effect on your operations, on the convention center, as well as the GICC arena. Next slide is looking at your changes in net position for your electric fund and other proprietary funds over the last 10 years. Again, look, this is like your net income, net loss. Your electric fund had a decrease in net position in 2020 of about $4.6 million. In 2021, it had about a $4 million increase in net position. And again, this was due to the power cost adjustments, which were passed to the users, demand charges, as well as a capital contribution in the amount of about $2.8 million that the city received for infrastructure expansions. Your other governmental funds went from a $136,000 increase to about $8.3 million increase or change in net position as of June 30, 2021. And that is due to transfers in from other funds. BIDA basically received about a $5.3 million transfer in. GICC Arena Fund received about $5.8 million. And then the Convention Center received about $10.5 million of scheduled and planned transfers from other funds. This slide is looking at your electric and water and sewer fund bad debt reserves over the last 10 years. For your water and sewer, it's been pretty flat compared to fiscal year 2020, coming in about $1,588,000 compared to $1,601,000 as of fiscal year 2021. You had a slight uptick in your bad debt reserves for your electric fund, going from 7.9 million to about $8.3 million. The city, I guess, started in fiscal year 2021, started back utilizing a collection agency. And so hopefully you'll reap the benefits of that agency working to collect on these delinquent accounts going forward. This slide is looking at your fund balance for your general fund. Of course, that's your main operating fund, like any other government. as well as your other governmental funds, again, your special revenue funds and capital project funds as a whole. And so for your general fund, your fund balance went down from 21.3 million to 16.8 million as of June 30, 2021, while your other governmental funds went from 14.7 million to 12.2 million. Now your fund balance for your general fund is still pretty good, and it's still pretty liquid when you're looking at it as of June 30, 2021. Again, this is a snapshot, and time doesn't mean that it's always this way throughout the year. But if you look at your unassigned fund balance for your general fund, it was about $15.1 million, which is about 61% liquid when you compare that to the cash on hand at year end of $9.2 million. So to me, that's pretty liquid. Next slide is looking at your fund balance as a percentage of total expenditures over the last 10 years, looking at your general fund and then all of your governmental funds combined. Again, your general fund, special revenue fund, capital project funds, excluding your proprietary funds. And a good rule of thumb for June 30 local governments is to have anywhere from 2 to 3 months reserve, or 16 to 25% of reserves in your fund balance. And you all still are doing pretty good. Although that percentage did decrease for 2021, going from 64% down to 59%, it's still pretty strong, representing about 7 months reserve. And so again, the city has not had to issue any tax anticipation notes to get you through those subsequent months until your property tax revenues come in. And so again, having that strong fund balance and that strong reserves, you don't have to rely on tax anticipation notes like some other governments have to.
Mr. Moses, quick question for you there.
Yes, ma'am.
That fund balance as a percentage of total expenditures also includes funds that are owed to the general fund, correct?
Yes, pretty much.
From other funds.
Yes. So yes, it's included in your total assets minus liabilities, and that's your remaining fund balance. So yes.
Okay.
All right. All right. So we did have one finding that was deemed to be a material weakness based on the dollar amount of the adjustment. And it pertains to capital asset reporting during our testing of capital assets in your FAA project fund, which is a proprietary fund. We noted about $678,000 of assets that were depreciated. And during our testing, we noted that it shouldn't have been depreciated. It should have been construction in progress because it hadn't been put into service yet. And so we had to make those adjustments to properly reflect that. And so just need to make sure that we're, you're looking at all your CIP and just making sure that you only start depreciating those items when they're put into service. All right, so we did have 5 management points. And again, we always like to have this particular one in here just as a reminder, dealing with your cash flow needs for your proprietary activities. Again, as you're looking at your external financing, as you all know, subsequent to year end, the city did refinance about 5 of its revenue bonds to kind of free up some cash flow. To help out with, again, operations kind of shutting down for your convention center and the arena. So even when you're looking at the external financing, you also have to consider your internal financing between your funds. And so you have, large balances that's due to other funds for like convention center and BIDA and also GICC. At June 30, 2021, you had advances of about $4.2 million that will be paid in more than 1 year to other funds. Then you had about $19.3 million of interfund balances that were due within 1 year. So technically, you're saying that the $19.3 million will be paid back by June 30, 2022. And the makeup of that, for the most part, is the electric fund will be paying the general fund about $6.2 million. BIDA will be paying back $11.1 million. to GICC Arena, Water and Sewer and Electric Fund, and that's going to come from land sales. And so, and again, just keep that in mind as you're looking at your external financing and cash flow needs, that you also have to kind of look at the internal financing needs as well, and stick to the city's repayment plan that was established back in 2013.
Doug,
Yes, sir.
just to follow up on what the mayor said, not only do other funds owe the general fund money, but there are also this debt service that has been pushed forward a couple years.
Correct.
And so the amount of money in the general fund is a little bit illusory as far as reserve goes. They have to, all those things have to be in consideration.
You're absolutely right. That's why I said it's a snapshot in time, and then also looking at, again, with your debt service payments kind of being deferred, you have to kind of look at all of those cash needs when you're considering, again, the internal and external financing and your cash flow needs going forward. That's absolutely correct. Okay. The second management point deals with customer deposits. Again, this is a repeat. Again, no major issues noted. It's just that we're accustomed to seeing separate bank accounts for customer deposits, with that balance agreeing to the actual customer deposit liability. The city went to a pool cash environment, and so all of that's kind of lumped in with your operating pool cash. And so again, we just continue to have that as a recommendation. But with our testing, no major issues were noted. The third management point deals with the GFA loan compliance. This was considered a finding in the prior year, but the difference this year wasn't significant enough to warrant a finding. And so we just made this a management recommendation. And so the fixed charge coverage ratio should be at least 1.05. You all fell just short of that, coming in at 1.03. And so just you want to kind of monitor that, continue to monitor that on a monthly basis, so that by year end that you're in compliance with that loan covenants with GFA.
A quick question.
Yes, sir.
Well, I guess it's in for you. I guess, Althea, have we separated the accounts, the customer deposit? Have we done that yet?
Not as of yet.
Okay, so when are we going to implement that to remedy that that issue?
As soon as the cash flow needs are met for the electric fund, because I would have to transfer funds from the general fund to make that balance.
Okay, to separate the accounts?
Yes, for the electric fund, because it's the electric fund. I have to make sure there's enough cash to move over for the electric fund for the customer deposits.
Okay, so the customer deposits payables, the electric fund money is mixed in with the customer's deposits? Is that what?
It's in one bank account, correct?
Okay, I guess what I'm asking, so to separate those, I mean, you're not saying we don't have enough funds to separate them. That you're not saying that, are you?
No, we can have this discussion offline.
Okay, good
Okay.
enough. No
Thank
problem.
you.
I got you. All right,
But that's a third point,
yeah.
following
Yes.
up on, starting with the first point made by the second, by the mayor, and the second by me.
And if we will have enough as of June 30th, 2022. So when they come back, we'll be okay.
Any other questions on those three? Okay. And then during our testing of your census data that's sent to your actuaries use this information to determine what the city's net pension liability is, along with the deferred inflows and outflows of resources for financial statement purposes. And so we just noted where one employee's date of birth in the census data was not correct. It was looking at the personnel file, it should have been something else. And so we want to make sure that information is accurate as possible. That's being sent over to the actuaries. Again, this wasn't significant enough to change their calculations or anything like that, but just want to make you aware of that. And then with the personnel file maintenance during our testing of some of the employee personnel files, one of the files were not provided because it was in the custody of the police department investigating the fraud previously. And so just want to make sure that the city implement a policy, and you may already have that policy, that prevent employees from removing files from the HR department and taking them home. All right, some new GASB standards that are out. And we went over this in previous years, but GASB 87 dealing with leases is going to be applicable for the current year that y'all in, fiscal year 2022. And it's going to require you as well as other governments to assess all of your operating leases. And most of these leases will need to be recording a liability as well as an asset. And so again, just you want to make sure to assess every operating lease that the city has and start evaluating and making sure that you're ready and in a position to properly implement this standard for the current year that we're in.
Doug, which one are they reporting or not reporting? The liability side or the asset side?
Well, under the current standard for operating leases, those leases that are not under the current standard, if it's not a capital lease, which you do record your capital leases as an asset and liability, but some operating leases, you're just disclosing that information in the footnotes and you're only recognizing the payments, or you might be on the other end where you're receiving lease income. You're only recognizing that when it's received. But under this standard, you will have to actually reflect a liability and an asset, or a receivable and deferred inflows of resources. So it's a little kind of complicated. But again, we've been having CPE classes for the last 3 years, kind of keeping our clients abreast of this and making sure that our clients are prepared for it. And so again, we've had some governments to actually early implement this. And so again, I don't foresee this being an issue, and I've been talking with management about it. So at College Park.
Okay, now that doesn't, I know sometimes with some of this stuff, how it can cascade into something else. So that doesn't skew any of these budgeted pots of money at the end of the day or anything, does it?
I don't think it's significant.
Okay.
Like some other governments have a lot of leases, and it could kind of throw some things off and how it was previously reported. But for you all, I don't think it's going to be that major.
Okay.
GASB statement number 91 deals with conduit debt. And so this will be applicable for 2023. And you all right now haven't had any issues reflecting conduit debt in your footnotes as far as the outstanding balance as of your fiscal year end. But some governments in the past, development authorities issue, a lot of conduit debt over the years. And sometimes it's difficult to determine what that outstanding balance is at year end. And under the current standard, you're allowed to only disclose the issuance amount in your footnotes. Well, this new standard says you no longer can do that. You have to disclose what the outstanding balance is at year end. And so we're encouraging our clients to kind of get in the habit of almost treating conduit debt as if it's your own debt, kind of confirming those balances at year end, or kind of throughout the year, so that when it's time for the audit, that information is readily available. And so you're not running into any issues. And so, but I do have some clients that have had issues with obtaining that information. So they're kind of jumping on this now so that by fiscal year 2023, they don't have any issues.
Doug,
Give me the explanation of conduit debt so that I.
Yes. So
the quick explanation.
Yes. So you issue debt on behalf of others that you're not responsible for repaying. So you have some That's good.
Yeah, so this is like when if we float a bond on you know, as a pass through for an outfit and it doesn't, I found.
Yes, sir.
Okay.
Good
I got
example of this is the one out on Fayetteville
Was
Water.
Fayetteville, right?
it. Yeah.
Mhm.
Okay. Got it.
Yes, sir.
All right.
Good question. Okay. All right. And so last thing I want to talk about real quick is that we continue to offer free continuing education classes for our clients. You can see the various topics that we've covered. We try to do this at least 4 times a year. With all the issues with the federal dollars that have come in, we've actually had multiple classes to keep our clients abreast of those updates and things of that nature to ensure that they were recording the CARES dollars and ARPA and all that stuff correctly. But again, normally we try to do 4 times a year, but this past year we probably had about 8 sessions, and I appreciate City of College Park management and staff for attending those classes. And so, and we try to provide governmental newsletters to our clients as well throughout the year. And so if you want to be included on that invite list or that mailing list, just shoot me an email and I'll make sure to get you added. But that concludes my presentation. It was an honor, again, to provide services to the City of College Park. Hats off and kudos to management and staff for always being very responsive and proactive and with the audit. And so again, another good year.
Thank you, Mr. Moses. Any questions?
Yeah, one quick one. Doug, I know we talked, I don't know, I guess last month when we got this thing in and I asked you, you know, we went over some of this stuff and then answered a lot of my questions. Now I remember, you know, used to be back in the day, we had a different format or whatever. So you gave us a grade from A to F, and I want to make sure it was that same grade so that, you know, a lot of times when you cut the simplicity of this thing, so where are we at in terms of where the average citizen can understand what we're looking at here?
Sure. So I like to look at it from an audit perspective. How responsive management is, when I'm talking about management within the finance and accounting department, how quickly can the city address requests for, you know, things that are needed to get the audit done, how quickly and timely the audit can be performed, doing our walkthrough procedures of internal controls, you know, our bank reconciliations being done timely, things of that nature. So I give the city an A+ with that. So again, to allow us to kind of come in over a short period of time and do a solid audit, anything that kind of pops up that we need, management is very responsive to address those items and work with us on it, and nothing really lingers. And so again, we haven't had any issues like in yesteryears with, you know, being 2 years behind on the audit and bank reconciliations not being timely reconciled, you know, almost a year behind. You all haven't experienced that with your current management and staff. And so again, A+ from that perspective. You know, as far as like, you all used to always ask about the number of findings and things of that nature compared to some of the other local governments in the Metro Atlanta area. Again, only 1 finding. And again, that's going to happen. You know, a couple of things might just pop up that you might run across. And so that's not a major issue from my perspective. And then like I said, with the 5 management points, nothing too alarming there as well. So again, I give you the City of College Park an A+. We're looking at those 2 areas.
Any other questions for Mr. Moses? Hearing none, appreciate your time. Thank you so much.
Thank you all.
Thanks, Doug.
All right, we have one other item on our agenda, also related to finance. It's the second quarter fiscal year 22 budget and financial review with a 3-year forecast. Ms. Floyd Bradley, floor is yours.
Yes, I would like to introduce who many of us know, Ed Wall. He will be presenting the fiscal year 2022 financial update.
Thank you very much, Ms. Flora Bradley. Hello, Mayor and Council. How you doing? Is it all
Right.
right if I share my screen?
Yes, please. Thank you.
So we'll start off with the general fund. If I could get everybody's attention, look at the budget for 2022.
Ed, is there a corresponding packet page? I'm just curious where you're starting off at, if there's one in this packet at all.
I don't know, Councilman Carn.
Councilman Carnes, there isn't. Would you like me
I'll
to
send this to
email
all the
this?
mayor and council.
Go ahead.
That'd be great. Yeah, if we don't have it, that'd be, if we don't have it. Okay, yeah.
So we completed it on Saturday, Councilman Carn. So the reason you don't have it in your package, I guess it wasn't ready to go out. And so if I could get everybody's attention, the general fund's budget was 28,115,000 right here. We're talking about our fiscal year ends in June 30th. So the FY22 year is July 1 of 21 to June 30th of 22. So this 50% number here would be July 1 of last year to December 31st of last year. So it's 50% of our fiscal year. So this is 50% of your annual budget. The actual results we had for the first 6 months is 14,282. So we got 51% of our revenues in. So to me, that's good. You're on track. As Councilman Clay always talks about, they aren't linear. Your taxes up here, 21 million. That's property taxes and sales taxes. But property taxes, for all intents and purposes, all come in at one time. This year, the taxes were due in January instead of December. So this number could be a wee bit higher. When we do our third quarter results in April, that'll be the results through March 31st. You'll probably see a much bigger number. But even given the property taxes weren't due to January, we still got 46% of our revenues in for the first 6 months. License and permits, the bills go out in March and they're due in April. So that's not a linear revenue source. And then this intergovernmental right here, the big lick there is the ARP money, the $2.8 million. That was the ARP money. The good thing is we didn't budget that, so that's good. Let's go to expenses. The total expenditures, 50% of your budget is 15.8 million. Your expenses for actual for 6 months, 16.1 million. That's 51%. That's almost directly on budget of 50%. And for 6 months, the general fund was almost break even, quite $86,000 negative. So it's almost break even. Nothing jumps out except for right here. The general government was about 500,000 greater. Ms. Flora Bradley, you had told me, and I forgot what you said. What's the reason that was up about 500 grand?
Most of that was we paid out a claim.
300,000.
Yes. And another 169,000 was general liability insurance coverage that needs to be allocated throughout other funds and departments.
And inspections, you can see here with 37%. But the reason that number is lower, Ms. Flora Bradley, was the personnel and some sort of software we haven't implemented yet.
That is correct.
So the general fund's good for the first 6 months. I'm really pleased with it. I think y'all should. I think we can put a check on the general fund. Any questions?
Yes, I have one, and
Yes,
that is sometimes we delay expenditures for budget reasons, what have you, into later in the year. And I know we have an issue on the agenda tonight with the regular session to buy a replacement police car. And the conditions under which that has occurred lead me to believe that we might have some other police cars that are going to need replacement. So what comes to mind is, are we going to have a bunch of expenses that have been pushed into the second half of the year that we don't have, that aren't linearly distributed, so to speak, over the year? And I guess staff would have to answer that. Mercedes, probably you're in the best position, I would think.
Yes, sir. We will have some that they are holding to the last minute. We have asked everybody that if they have anything budget to start pushing them forward, but we will have some.
Thank you.
The good thing is that we've got a budget, Councilman Clay, of this 31,622,000. So hopefully we won't exceed the budget.
Right. I'm hoping that. I just want to paint a realistic picture of the budget that
Yes, sir.
we're doing it. Staff is doing an outstanding job, I think, of managing the budget, both from a revenue and an expense standpoint, primarily expense standpoint, because they don't have a lot of control over the revenue part of it. Hopefully when Mercedes gets back to the convention center, she can give us a boost on that. Or when if you're back now, anyhow. So I'm very appreciative. I just want to make sure that we understand that we're not fat, dumb, and happy at this point on the budget.
You're right.
We're good, but we're not falling off the edge, but we're getting pretty close to the edge.
But well, Ambrose, and I piggyback on that. Yeah, we look good, but the second half, the tide comes in, and this year in particularly, there are a couple of other things, notwithstanding the budget, which, there are going to be some asks, absolutely. But my worry is that here at the end of the day, talking with our new manager here as well, we're going to have to expend some funds in terms of some salary issues, some things that we're woefully inadequate in terms of budgeting and salary and whatever have you, that we're just going to have to do between the second, third, and fourth quarter here, from what I see, because we're steadily, hemorrhaging employees and staff because the surrounding cities are moving in terms of expenditures and to do to retain their staff. So in addition to the asks at budget, which I know none of them are necessarily employee raises per se, that train's still coming this year at the end of the day. So we've got to really look at that, and we've got to look for some additional Easter eggs. Ken, you and I talked about one this morning. Mercedes, you're working on a real good one for us. That next week is another big Easter egg, right? And when I say Easter eggs, I mean 6-figure, 7-figure Easter eggs. That's what I'm looking for.
Right.
We just got to, like you said, Ambrose, we got to keep that in mind. But even with the budget that they're going to bring us, I think there's going to be some more coming and some things we're going to have to bite the bullet on if we want any holiday employment at all in College Park. Because
Well, we're going to see double-digit inflation. There's no question about it. And people who are going to the grocery store for that segment of their expenses is seeing a heck of a lot more than double-digit inflation. And that impacts us throughout the city. It employs employees, it impacts all our expenses.
And Ambrose, but that's going to lead us to double-digit exodus of staff consequently. So that's what I'm talking about.
Yeah. So, you and I, Joe, are on the same page.
Okay.
I agree. I think we have to keep our finger on the pulse the whole time we're here, but we also have to recognize, some of the issues that are coming up and address some of those as well. So, it's good to see where we are, but we have to be very, very careful.
And before I leave the general fund, Doug Moses tonight was talking about your general fund balance. And so you can see that it went down by 4,482,000 in 21. So it dropped from 21 million to 16 million. And he equated this figure as a percentage of your expenses. And you all do have a very healthy fund balance. But the thing that y'all got to pay attention to is only $9 million of it is cash. The rest of the fund balance are funds that are owed to the general fund from these various funds over here. And we're hoping in April, with the sale of some property at 6 West, that we can resolve this and bring the fund balance back to all cash. But right now it's not all cash.
And we need to be looking for other ways to bring in additional money as well.
Yes, sir.
Those Easter eggs.
Go to the next fund, the electric fund. So the purpose of these quarterly numbers is to help you all measure the things that you have done and how is it working out, and is it working, and do you need to do anything different, or you just need to stay the course? So the electric fund in 2019 had lost $3.8 million. In 2020, it lost $4,601,000. So you all made the hard decision in June of 2020 to raise the rates. And you can see here the revenues jumped from 27 million to 34 million. It had the desired effect that you wanted to have it happen so that you could fix this fund. So we look at the budget for 22, the revenues were 39,507 budgeted, 50% is 19.7. The actual was 18,000,007. So it's about $1 million less, 47% of budget. It's a good thing. The big expense item is the electricity that you purchased from MEAG. It also was $1 million less. So clearly, evidently the temperatures weren't as hot in July, August, and September, and maybe they weren't as cold in October, November, and December. So you sold less electricity, but you also purchased less electricity. And so the electric fund has dropped 781,000 of revenues over expenses. And remember, the purpose of this is that the electric fund owes money back to the general fund. There you are, 6,211,000.
Ed, you aren't the right person to answer this question, but what I'm wondering is, and I wonder if you, Richardson, is on the call yet, what percentage of that is Plant Vogtle charges? I know we keep reading about in the newspaper about how it's impacting Georgia Power costs. How much of Plant Vogtle is already being reflected in our wholesale rates that we're paying? I assume that's where it would be reflected. And if so, if it's not, I should say, how much is likely to be coming that we haven't been hit with, that Georgia Power customers are being hit with?
Yeah, the answer is none of this is Plant Vogtle's, at least the units 3 and 4. We sold units 3 and 4 to another states for 20 years. So we don't have to worry about that expense for 20 years after the commercial operation date. So none of this is Plant Vogtle. And just to expand more on the 47% versus 47%, the reason those numbers are lower is because the data center don't ramp up as fast as we thought. So we sold less, but it cost us less because MEAG sold it. So that's why there's a difference.
That's extremely good news. In fact, I'd forgotten about that we didn't, I knew we didn't owe the rates, I guess, for 20 years, but I didn't know about the capital aspects of it.
We don't have no expenses whatsoever.
We don't have any. Oh, that is extremely good news, guys.
What we got to hope is in year 21, when we do start paying, electric rates have all risen over the last 20 years, and it doesn't appear that we'd be paying too high a rate in year 21.
Right.
And Hugh, while you're on, the electric fund is a big, when I came back in here, I said to myself, we've done a lot of modifications and adjustments with this thing. I watch how the other cities can manipulate those electric rates. A lot of the times, if there's certain things you want to do, there are only a certain number of levers we can push. And the utility fund, because we have control over it, we have a whole lot more latitude than most of these other cities. some of the other MEAG cities I've seen, you know, if they say it's so many different adjustments. You can let's say you want to raise the rates. You could increase, let's say, the senior discount. You could, while increasing the general residential, which this is stuff I've seen in other cities. A lot of what had happened this year and last year, some of the cities that said, well, we got a lot of folks that got a lot of this stimulus money and nobody's going to work. Well, in a city in Fulton County, I won't call any names, they say, well, if you want more folks getting back to work, you got to make it a little more uncomfortable to stay at home. So they'll raise the rates on the general residential, decrease the senior rates by increasing the senior discount. And again, there are levers and dials that we have the luxury of using if we so choose, that the other cities don't. So we want to keep all of that in mind, that we've got another panel that most cities don't have to look at and move around and adjust. So Hugh, you know, I know we owe you a lot of money, but there's still some, you know, we've got to look at, you know, what's going to happen coming in with COVID. Apparently there's going to be a fourth booster shot. Right now, they're already approving it for folks that are immune compromised. You can get a fourth booster shot already 6 months after your third. And they're not calling the third one a booster anymore. So now the fourth one they're calling the booster. So there are a lot of changes coming, but I just want us to keep in mind some of the things that other cities are doing that we may or may not want to do, but there are a lot of options. And Hugh, at some point, I like, maybe we do a workshop just sitting down and seeing, you know, what dials and buttons we can push if we wanted to, and what the outcomes would be on some of that stuff. So just.
Well, stand by. I got a presentation I want to show you in June. I got it in the budget,
Okay.
so I'll do it.
Okay.
Councilman Gay? Sir, you're muted.
I have a question. When Mr. Walls and Athea bring us the budget, is this always a cash and accrual blended budget, or do they ever present this to us on a cash basis?
This is
Is it
cash.
cash basis?
Yes.
Yep.
Because
This-
you said that, I'm sorry, you said that some of the revenue was projected from the funds. You said we don't actually have that money. So that makes me think that's accrual, right?
Well, the previous year's fiscal year, the 2019 actual, 2020 actual, and the 2020 actual is on an accrual basis. Your budget is on cash. So it's a blended here because the
So
years
these are
have been audited.
So like one thing you show here, Councilman Gay, see the depreciation number?
Okay.
And that's a non-cash item. So the audits include them, but notice the numbers we present to you do not include them because it's not cash.
Okay.
So we present you cash. You know, I think to me, you as managers of the city, you need to know how much cash you got, cash going in and cash going out. So I think this would be the most useful for you in managing.
Okay.
Wait a minute, Ed. You told me all of these figures were in Bitcoin. Which one is it?
I wish it was. Man, we could eliminate property taxes and go on home as long as we sold it today. All right. Electric fund's good. I think we put a check in that. It's really running real well. The things that you all did in June of 20 have worked out. The water and sewer fund. So we raised rates June of 20. So you can see here the revenues are 8,414,000. It had a net negative position of 592,000. So you all raised rates in June of 20. And so you can see here it was a 5% rate increase. And it in 21 it went to 8,000,008. And so 10% of 8,000,004 would be 840,000. So 5% is 420,000. So it was a direct result of your rate increase. So it worked. Let's go to the budget. The budget was 9,038,000, about the same as it was in 21. 50% would be 4,519,000, and actual is 4,965,000. So we brought in 55% of the budget as far as revenues. So that's a good thing. So revenues checked out. Let's go to expenses. Cost of sales, we buy water from East Point, Atlanta, and Clayton County. The budget was $5.8 million. 50% is $2.9 million. We spent $3.241 million, about $300,000 more is 56% of the budget. So there's still something going on with water and sewer that we can't quite figure out. You all as mayor and council, y'all took care of the revenue. And so down here, we have for the 6 months, we have $137,000 revenue and exceeding expenses, but your annual debt service is right at $1 million. And so you heard Doug Moses tonight say he gave us a fine and we had 1.03 instead of 1.05. I'd like to see y'all have a coverage factor of 1.5. If you ever had to borrow money on your own and not go through GFA, you need a much higher coverage than 1.05. So if you go up here for 21 actual, we had $170,000 was a net number. This depreciation is $846, so it's not cash. So we had right at $1 million in cash available to pay that debt service. And so you need a wee bit more, but I think if you all work on the expenses, you might figure out, I don't know if we've got leaks like we did out of the water tower somewhere.
I was going to say leaks, maybe.
Yeah. So the new city manager, Mr. Arnetta Tyus, and I and Althea have talked, and she's going to impanel a group of folks, a team to meet. I don't know if it's this week or next week, and they're going to start and bring back to you what they decided to do about expenses to try to make this fund squeeze a wee bit more money out.
Did East Point and Clayton County or anybody go up on their rates?
I
And
don't know
charge
the
us
answer.
more?
East Point did go up on their rate a little bit, I believe.
That was a couple of years ago.
Yes.
Oh, okay.
What I would like to hear is if Melissa could give us a report on the amount of water we're delivering versus the amount of water that we're buying. Because at one time we had leaks in the neighborhood of, I think it was 20%, literally 20% of the water that the city bought wasn't getting used by a customer.
Yeah, we had big leaks, Ambrose. And I remember also, we paid some fella, and I remember the exact number, $243,000. And this guy supposedly was gonna CCTV cam all of the pipes and find every leak in the system, supposedly. And obviously that didn't happen. But I'd like to know what is East Point's water now? I mean, when I left here, it was $3.40 per 1,000 gallons. So I'd like to know what it is now. I don't want to fall out my chair though, but.
Can we get a more detailed report on the water and sewer issues? I mean, it sounds like there's some real interest amongst the body to dive into that. So it may be a good conversation for our next workshop.
Yeah, and Mayor, I'd like to know where our leak detection network is. We had installed several years ago, Joe, I think you will remember this, that we installed some leak detection devices that basically listened to the water flow through the pipes. And at certain times of the night, for example, you wouldn't expect a bunch of water flow.
I remember. Yeah.
And I would like to know whether those leak detectors are still functional and what do they say and et cetera.
All right. So why don't we?
Do we even know where they still are?
Well, why don't we get Ms. Tyus to get us some information on that at a future workshop, and we'll move forward.
Okay. And Hugh, one quick last thing, Hugh, I wanted to double back one thing with you. Hugh, I guess we had a relatively mild winter this season here. I mean, December was like South Georgia or North Florida, basically, if y'all remember. I guess my question is, we raised rates, but was there a big bump in terms of reduction of per se?
Yeah, you're right. You're right. December was not was warm, but January and February made up for it. The
Okay.
heat and degree days were the highest in January and February than we had in several years. So,
Well, I'm assuming we're going to be coming out of things in March. So the bump that we usually get, you made up for it in January and February?
yes.
All right. Okay.
So on the water and sewer, I think I'm going to put a W in there. We're going to work on it. Convention Center Fund. So pre-COVID, 2019, we had almost $9 million in revenues. In 21, it dropped to $1,912,000 because nobody was booking events. When we did the budget for June of 22, the FY22, we did it June of 21. We hope to get $7,269,000 in revenues. 50% of that is $3,006,000. I'm pleasantly surprised that we've brought in $2.9 million in revenues in the first 6 months. While it's only 40% of budget, we did much better than I thought we would. Let's look at expenses. The expenses are $3,620,000. The expenses are called cost of sales, purchased, personnel services, and other operating expenses. And so we have an operating deficit through 6 months of $702,000. Now, if you look over here in 21, we had an operating deficit of $6,506,000. Now, to go back to Councilman Gay's point, you can see depreciation here in the audit. It's a non-cash item. If I take $2,007,000 and take that off of that $6 million, I had about $4 million in an operating deficit. If y'all remember, the general fund stroked a check to this fund so they could pay its bills. So unless things improve the second 6 months, this number times 2 means the amount's going to have to be $1,400,000 from some other fund, and it could be maybe hotel motel tax. The good thing about this year is we've helped with the debt service, and we dropped. These numbers here are interest only. The auditors don't show paying out principal. They work that out on the balance sheet and assets and liabilities. But the debt service, principal and interest used to be about, I think, $5 million in this fund. And so here it's only $812,000. That's principal and interest because of the refinancing that we did. And so we got $1.4 million that this fund's likely to have us have to pay into it in order for it to pay its bills unless they get more revenues. And we talked about trying to save expenses. You think about it, the budget was $8.5 million. 50% of that is $4.2 million. So they have indeed, the staff they've cut expenses. It's only 42%. And so the expenses are trying to be in line with the revenues up here. But for the next 6 months, we either got to have more revenues or cut expenses, or y'all going to have to stroke another check.
I was going to ask about the 3.6 operating budget. I was going to say, wouldn't our operating expenses be down? I mean, in terms of wear and tear and cleaning supplies and everything else, but that shows it with 42% drop. The debt service drop. I mean, that's great, but that's, I discount that because that's just kicking the can down the road. So, I mean, it's great now. But
I mean, you're right, Commissioner, we'll want to pay in later, but we had to have the cash flow relief now so that the general fund would quit hemorrhaging cash.
Yeah.
And so the good thing about, we were talking about it, Mr. Arnetta and Althea and I, we got Mercedes back at the convention center, and it was almost like Elvis is back in the house. And so I would hope that, good Lord willing, and COVID easing up, we'll be able to produce more revenues. We talked about it last year, closing the doors and shutting expenses, and we decided you couldn't be in business unless you were in business. And so we made the decision to try to cut the staff to the bare minimum and stay in business so that we could do business. And, $702,000 is all it was out of whack for 6 months. That's way better than it was in 2021.
Ladies, if you're still on, I I was coming back from the funeral of our officer there at Woodward, and driving down Camp Creek, I saw the parking lot was full at the convention center. This was the day of the funeral, the Saturday. So I pull in when I see the parking lot full. I'm like, that's good news. So I'll go in through the back, and I found out, I asked them what's going on, and they take me out to the exhibition hall, and it is completely jam packed in there with the volleyball tournaments. And I walked around the perimeter of that place, and I was glad to see it was full, but it got me thinking about something in terms of revenues that we may have totally missed when stuff like that comes around. And I want to sit down and talk to you about it and see what you think about it. I'm not a marketing expert by any stretch, but there was something that I've seen in some other places that when we get those kind of audiences that we can possibly do, that won't cost us anything. So, but will bring us in some funds. So we definitely got to find some more funds out of the convention center, I think.
How was January, Ms. Miller? Can you give us some insight on that? Because obviously the Omicron variant was pretty prevalent.
January was not as high as we would like, but February through June, they're pretty busy. So I'm hoping that we can pick it up on the other end.
Well, also, is there any chance of us picking up any additional money by using the GICC as a vaccination area, for the government? Have we got any other monies coming in, or?
No, they don't like to pay for those events. When we did get money, it was for some of the services that we provided, but they do not pay for the space. So we're basically taking the space out of production, but we're not getting paid for it. So I think if we're given a little time, we'll be able to pick up some more revenues. If these are through December, then I'll go back and I'll do a forecast, but I know we're doing a lot better for February through June.
And we have graduations coming up.
We do.
And, there's one other thing we need to think about, and I don't know how significant it will be, but to the extent that with sale of BITA property, for example, we foster other recreational facilities that have the ability to take away from the convention center some of the things that are going on. We need to think about that, because we're putting organizations potentially in competition with ourselves. Now, if they bring in additional benefits to the city, it could be a synergistic thing. But we just have to be mindful about what we're selling land for to create potential competitors.
Good point, Councilman Clay. Anything else in regard to the convention center, Mr. Wall?
Oh, ma'am, that's right. I kind of want to put a check in it. It's much better than I had thought, and there's not a whole lot y'all can do other than pray and Mercedes be able to book business, she and her team.
Yeah.
So I put a check in. The next one, and do I have a time limit, Mayor? How much longer we got?
Yes, sir, you do have a time limit.
So do I need to talk like the FedEx man? I mean,
no, it's okay. Our regular meeting starts at 7:30, but it'd be nice to have a little bit of a breather in between.
I'll try to speed it up. So here's the Redevelopment Authority Fund. That's what the auditors call BITA. And so the revenues for BITA are pretty simple. They're the pilot payments we get. They're the land rent that we get for the land that some of the buildings are sitting on. We get APM fees, and then we get that small property tax in that special district that goes around the GICC. And so the budget for 22 was $3,422,000. 50% is $1,711,000. We got $1,787,000. So that's 52%. Those revenues are great. The depreciation here is non-cash item, so we don't budget that. And so the other operating expenses, $540,000 was a 50% number. Artie's managed it. He and his team only spent $312,000 or 29%. That is an excellent job on keeping your thumb on expenses. And so they dropped $1,474,000 to the bottom line, which is really good for the first 6 months. The real story of BIDA, of course, is the sale of property. And so we had budgeted $3.5 million to be conservative. We haven't sold any property in the first 6 months. However, we do hope to close on Southeast Capital for $8 million in April. And then the other big story for BIDA is it owes these other funds $12.5 million. So that $8 million will go straight down here and wind up through all these different funds back up into the general fund.
And Mr. Wall, there was a write-off. Am I correct?
Yes, ma'am.
And so that 12.5 is actually a little bit larger.
So we put, I think, $4 million in the convention center fund and $1.5 million here, but the auditors wouldn't let us book it as a loan because we've been promising year after year that we would pay this back. And last year, because of COVID, not only did we not pay it back, but we added to the balances. And so they said enough was enough. And so they made us start writing stuff off. It wouldn't allow us to book that as a loan. So they just booked it as a transfer. There's nothing stopping y'all from mayor and council later on when we do continue to sell more property in 6 West to pay back a greater amount than this to the general fund. Any other questions? So the BIDA fund is good. We just need to make sure we sell land. The car rental fund. The big story here is most of y'all know the intergovernmental contract with the city of Atlanta that we levy the 1 penny and give it to them. They get the first 8.8 million for the Hawks Arena. We get the next 3.2 million, and they get the next million. And then if the car rental tax brings in enough, we'll split the rest of it 60-40, with 60 to us and 40% to them. And so when COVID hit, March 20, travel went down. The car rental tax fund gets paid to us. The car rental tax revenues get paid to us in December of each year. And so in December of 20, for the June 30, 21 year, we only got $180,000. So we worked out a transaction with Atlanta that if it went for 2 years in a row, they had to true us up and make up the 3.2 million by stroking us a check out of their general fund. So we needed December of 21, which would be reflected in this fiscal year, to be less than 3.2 million, and it was not. So we'll no longer be able to get a true up of the 3.2 million. But the good thing is we did get the 3.2 million, and so it has dropped to the bottom line. The car rental fund has $4 million in cash. That fund's used to pay the debt service on the arena and the debt service on the public safety building.
So in essence, and you're saying that we basically lost a year of 3.2 million.
Yeah. So we got 180. So we took a $3 million hit in 21 that we had hoped to get back, and it won't come back to us.
Right.
So this fund's is doing great. We got the 3.2 million. We'll get the 400,000 that they gave toward the APM station. So this fund's back to performing. The arena fund. So the budget for 22 was 2,107,000. The 50% number would be 1,053,000. Actual revenues was 669, or 32%. The expenses were budgeted at and you can see here it has depreciation in here. No, there's no depreciation. There's no depreciation in here. And so here the budget was 6,248,000. The 2,008,000 of it is the debt service. And we know that comes from car rental tax. So this would be the operating cost here. So we had $669,000 in actual. Here's the actual expenses. And that's about $1,300,000. Let's round this up to 700. So it operated at a deficit of $600,000 for operating deficit. That number times 2 is 1.2 million. So unless something happens the next 6 months, we're gonna have to stroke a check into this fund of 1.2 million, either from hotel motel tax or from the general fund. And the good thing is, because we did the refinancings, the hotel motel tax fund, there's going to be more money available for operations where before it all went to debt service. And so you will have a choice, I hope, to use hotel motel tax to make these subsidy payments rather than the general fund. And these projects, the arena and the convention center, they're directly related in driving some of the hotel motel tax business. So it's appropriate to use that fund for those costs. But, you know, this fund just needs work, but nothing we can do but pray and hope for more revenues. Any questions? Sanitation fund. So this fund had a 10% rate increase. If you look down here in 2020, the fund had a negative $190,000. So you raise rates in actual to 21 here. You can see the rate increase did take effect, and we produced a positive 394. It had a deficit situation down here, so we restored its deficit to a positive. The budget for revenues for 2022 were 3,204,000, about the same they were in 21. 50% of the budget's $1,602,000. We brought in $1,636,000, 51% of the revenues. Good deal. Expenses, 50% would be $1,459,000. We only spent $1,338,000, 46%. A good deal. So we had a $298,000 revenue minus expenses, positive. And then how we spent it is a new garbage truck for $219,000. So we still had a $34,000 positive for the 6 months, but we were able to get the garbage truck because you all corrected the problem back in June of 20. So this fund's good. Last fund is hotel motel tax fund. I like to start off here pre-COVID. The 8% hotel motel tax that y'all have brought in $12 million. This stuff here is you have a special district property tax, and it takes care of itself. The big, property tax is based on the assessed value, and so it doesn't fluctuate a lot. We did raise the rate from 14.5 mils to 20 mils, and you can see the increase right here from $1,830,000 to $2,830,000 because y'all were able to raise the millage rate. But the 8% brought in $12 million. In March of 20, COVID hit. So you had March, April, May, and June with almost no hotel use. It brought in $8,480,000. And then in 2021, it brought in $6,224,000. So that was our worst year ever. Let's hope. So when we did the budget for 22, we said, let's budget $8,480,000, the same numbers we had in 2020, and maybe 22 will be like 20, where you have COVID 4 or 5 months, and the rest of it hopefully will be back to normal. So 50% of our budget was $4,240,000, and y'all look at there. We collected $4,476,000, or 53%. Now this is July 1 to December 31st. So the fear is we may take a dip in January, so we'll have to look at this again close when we do the third quarter results in April for January through March. But I'm so pleasantly surprised that the numbers look so much better than they did in 21. And so we had $5,360,000 in revenues. You had this number goes to the DMO, that 1.5% of the 8% by law goes to them. So it dropped $4,712,000 to the bottom line for you to use transfers for the other funds. Madam Mayor, that ends my report.
Thank you, Mr. Wall. Councilman Gay?
I just had a question. I noticed Doug Moses said that he didn't include the DMO fund, and you didn't include it. Is it not a fund that is part of our accounting?
It is not.
It is not, sir.
I know it's not because he didn't read it, but I want you to explain to me and whoever's listening why it isn't.
because it has to serve as its own entity, a separate entity from the city. So they just had an audit done, and we'll get in the audit reports, and I can send the council the audit reports.
We get into it later. I guess what I'm trying to understand is, like BIDA is a separate entity of and in itself. Why isn't the DMO fund part of our general county?
It's not a part of the city.
So I can answer a little bit about that. You appoint all of BIDA's members. So it is not a distinct separate entity. In the auditing world, they call it a component unit because you appoint all of its members. But the DMO, by virtue of it being set up, I think other folks other than somebody you can appoint serve on that board. Isn't that right?
The only thing that confuses me is the tax that we get for that money.
Right. So, Councilman K, you have an intergovernmental contract with the DMO where they promise to do certain services for you, and you are required, in order to go to the 8% levy, Georgia law required you to set up a DMO and pay it 1.5% of it. And so your recourse, if you don't like what the DMO is doing, you got to go get another one. But you don't, in order to levy the 8%, you have to give 1.5% to some DMO. And they're separate entities, so you have to rely on their separate audit, and they're like a vendor. So they give you what their audit is, but you're actually paying for a service under the law. Does that make sense?
I'm sorry, if you don't mind, I'm on the call still. And so within your financial statements, again, it's presented as a discretely presented component unit. So if you wanted to see that financial information within your statements, it's on page 17 and 18.
Thank you.
Yes, sir.
Is it treated differently, Doug, than BIDA though?
It is. BIDA is what you said was absolutely right. And so BIDA is a blended component unit. So it's shown within the city statements as a proprietary fund, just as if it was electric fund or what have you. But the DMO is not considered a blended component unit based on certain criteria. And so it's shown as a separate, has its own column on the face of your statements as a discretely presented component unit.
Got it.
All right.
Councilman,
any other questions for Mr. Wall?
Did that answer your question, Councilman Gay?
But now,
okay, yes, sir.
Any other questions for Mr. Wall?
Nope.
Any questions for Ms. Floyd Bradley?
Thank you very much.
All right. Well, thank you very much. We went through a good chunk of financial information there, but important information to discuss. So we have 12 minutes until our meeting. I'm not sure that's enough time to cover everything that we need to go back into executive session over. So why don't we just go ahead and pick up at 7:30 with the regular session meeting. We'll see everybody in a few minutes.
All right.